So good evening, everyone. Before we start, I'd like to draw your attention to the disclaimer on screen, which I'll read for you now. All information that is provided during this seminar is for educational purposes only. The presenter is not a financial or investment advisor and is not authorized to provide recommendations on any instrument of any kind as part of this presentation. The strategies showcased are applied on hypothetical scenarios. Any instruments that are mentioned throughout are cited only for illustrative and educational purposes. The webinar is not intended to be a personal recommendation and must not be construed as advice from the presenter. Pepperstone doesn't represent that the material provided here is accurate, current, or complete, and therefore shouldn't be relied upon as such. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any instrument, financial product, or to participate in any particular trading strategy. We advise any listeners of this content to seek their own advice. So as I said, good evening, everyone, and welcome to tonight's Master the Trade webinar. Please feel free to put your questions on the chat the moment you have them, and we will answer as many as we can at the end of the presentation. So markets remain nervous, although quite bid right now, as COVID-19 continues to cause major problems for the UK and EU and potentially the US, where the recent election has overshadowed some huge increases in the virus cases. Regarding the US election, the day may be behind us, but the uncertainty potentially remains for financial markets. Will Trump contest, or will he need to? So Maurice Pomeroy will start there using his three-step process that he uses at the start of each week, something that he highlighted in week 2 of this webinar series, and he's going to discuss where we are on the US election and what it means for markets, before discussing the wider news impacting financial markets and important events for the next 2 days. He will hand over to Richard Adcock, who this week is focused on understanding trending, and will discuss how he uses the MACD indicator. Then he will go on to the live Pepperstone charts to discuss the technicals in real time. Roger Hawes this week is back and will explain our 4th trading strategy, how to add to a winning position, before finishing tonight's presentation by explaining the psychology of short and longer term trading. So Maurice, lots to talk about. Over to you.
Yes, good evening, everybody. Thanks, Chris. Obviously a very busy day, a lot of things to discuss, but bear with us. I mean, some of this presentation was put together earlier today, and obviously, you know, everything's in flux at the moment, so a lot of things have moved on. We'll try and sort of keep that fairly fresh for you today as we go through. But obviously, you know, we've seen, you know, the election start. We had a process before the election where we were pre-election. We saw the stock market beginning to sort of get nervous. We saw volatility higher into the process. We were worried that there might be a delayed result, and still we're waiting for a clear leader to sort of show itself, although Biden does seem to be out in front still. So stock markets had a 2-day rally into the election. 2/3 of the previous week's losses, as it seemed that Biden was going to be winning to some degree. Now, was this going to be the blue sweep that we've been hearing about, that he was going to have a landslide win? We saw the dollar sell off against major currencies as stocks rallied. We saw gold and other commodities react pretty well to that. You know, we saw an extremely large amount of early voting taking place. And basically, you know, it was all looking pretty good, as you can see here on this chart, for where we were pre-election, for Biden to take a pretty substantial win and possibly even take the Senate as well. The reality of that was not quite there. And I think, you know, if it's a bit like rating agencies, if you want to short something, I think it's selling pollsters, because I'm not sure anybody's going to ever believe them again. But polls were way off, and to be honest, it does make a bit of a mockery of polling. They don't get it right. They haven't got it right in most countries. There's not a company that seems to be able to get it right. We're still waiting for some of the counts as well. That could be delayed for a day or two. But if we look at where, you know, what we've got from overnight and into today, we had some claims from Trump, which was a bit scary, claiming a win so early, and then suggesting that, you know, he would launch a Supreme Court challenge because he saw fraud in it, and the votes hadn't even been counted. So I think that was something that the rest of his party has pulled him back on. And I think for this to get to the Supreme Court, unless it's extremely close and that he can actually show some evidence of any wrongdoing, then I doubt this can make it there. You know, we've seen the dollar initially rally, stocks retreated as the blue wave view got priced out. We saw markets dip, and then we saw a massive buyback. We saw stocks basically driven by the big 5 tech firms again, taking stocks all the way back up again. And you know, over the last couple of hours, we've seen some pretty big gains for euro. We saw wild swings in dollar MEX, dollar CNH. We've seen gold up a little bit. That's been rather disappointing, to be honest. I thought that would be higher. And oil has rallied as well on a slightly lower dollar. But overall, bit of a mixed bag. But the overriding issue here is that the top 5 stocks in the tech area, so Apple, you know, the FANGs, have driven everything higher. And there's a reason for that we'll get to in another slide. But at the moment, Biden is probably set to win, but there's a big doubt over whether he can take the Senate as well. So looking forward from here, there's a possibility of a delayed election outcome, which is in the red zone. We are worried about that. You know, that could turn this rally around a little bit. I think that there is a certain amount of momentum in stocks at the moment, driven by these top 5 stocks. And also, it does look like the blue wave Democratic clean sweep is over. So, you know, I think we've got to be careful of any uncertainty creeping in into the close and into tomorrow, in case there are some I mean, for instance, Trump is now winning Pennsylvania, which is, you know, deemed to sort of suggest he may still hang on to the Senate. So there's a lot going on here, guys. And I think even if we get a Biden win, it's what kind of win that still matters. And we don't know that yet. So I think we need to hold on to this. So there is still a chance of a contested election here. And, you know, Trump, I think he's not going to want to walk away from this with any kind of elegance. So I do think that there is a chance that he tries, if it's close enough, to sort of at least demand some recounts, which could delay, which could actually just turn this euphoric rally around a little bit as there's a little uncertainty thrown into the mix here. So what does a Biden win on a Republican Senate mean? I think for big tech, it seems to suggest that they can probably avoid, because it's a bit of a lame duck government that we could end up with on that basis. They feel that the tax hikes might be difficult to get through, which suits them. And big tech also feel that the idea of a Democratic government going after them to break them up is going to struggle to get through as well. So that's why I think we've seen this big rally in big tech, and that's dragged everything up in the stocks in the US. Taken the dollar down and allowed a certain amount of risk on sentiment grow today. It's not over yet though, so we need to be careful here. So, you know, there could be a less protectionist stance with Biden in the White House. So we need to consider a few things looking forward here. And the third step is that sort of vision ahead. Where are we looking from here with the information we've got right now? So it does look like Trump is setting the scene, if possible, to challenge the huge mail votes that have come through, and when they're counted and the rest of it. Pennsylvania and Michigan are still pretty crucial to what's going on. It does look like Trump is going to take Pennsylvania, but it's not been suggested yet. He's marginally ahead. There's a few swing states that are literally, you know, 50 to 100,000 voters in it, if that. And so, you know, some of these are quite close. So one thing's clear, neither candidate is going to concede, which means there is a potential drag on. And again, remember, investors don't like uncertainty, so there could be a bit of an issue with that. 20 years ago, we saw in Florida, Bush versus Gore, there was a similar issue. Eventually, the Supreme Court stopped the count and awarded the result to Bush. That took quite a lot of time, 6 weeks. I'm not sure we're there at the moment. I'm not sure whether Trump has enough evidence to call for this to get to the Supreme Court. If he does get it there, it is slightly loaded to the Conservatives, so it might help him if it does go there. So I think that would be a negative for stocks if this gets to the Supreme Court, but I think it's tough to take it there. Again, it's all about uncertainty at the moment. The market seems pretty certain that Bush, beg your pardon, I'm doing a Biden. I think Biden is probably going to win, and I think the issue here, the toss-up here, is what happens with the Senate, and I think we really need to be careful about that. If Trump maintains the Senate, then the possibility of getting anything tough through the government is going to be very difficult, and we could end up with a lame duck government for 4 years. We saw that with Obama, with so much hope and expectation from Obama. A lame duck government actually just cut his legs off. I mean, he couldn't do anything, didn't do anything of note really, and that's what basically could lie ahead for Biden. So it is a bit of a concern, but at the moment, momentum is certainly on the upside in stocks, driven by the top 5 or 6, 7 tech firms, and that's what's going on right now. That's about as up to date as I can get it. That's the politics. Where are the markets right now? Well, one of the things that is a bit of a standout, and it's in bold on the left here, is China economic data continues to show a strong emergence from the March lockdowns. I do think this data is with an opening of the China financial markets to see capital move towards China, and particularly Asia, where other nations seem to have got some of this virus behind them. And I think that's one side of the equation. The other problem being, one of the problems being, as a caveat to that, is that demand from the rest of the world may be dwindling fast as lockdowns start to move across the EU, and they may well be coming in the US as well. Keep an eye on oil. It's bounced a bit off after the election, and I think realistically there's a danger that this rally could be short-lived because, again, demand is going to be an issue. I'm not sure whether OPEC can hold together with its output limitations if oil stays weak. I think some people may break that. So the new 4-week lockdown for the UK, it actually started to impact sterling the other day. We saw that. France, Germany still getting exponential rises. Spain looks pretty awful. More lockdowns. France is got curfews. These things do impact the economic outlook, and I think we need to bear that in mind. And certainly China data, and in fact US data, is actually trumping EU by some considerable margin. And I think the EU rally is probably going to struggle up here. But I just wonder if the US is actually just lagging behind the EU. So I think we need to be careful on this. The US is not immune to this, and if you look at the numbers, they are actually getting quite high. And remember, they're reluctant to lock down. So the impact that, if we get another exponential rise there, the impact may be that a lockdown will be too late anyway. So there's real problems coming for the US on this, and it's something that they seem to be turning their back on, or certainly not focused on actually the lockdowns at the moment. The ANT or ANT IPO, if you like, the biggest on the planet, is an interesting story. Now, one of the things here, it's a bit macro this, but this was going to be one of the big events in financial history. But unfortunately, it seems that the regulators and the administration in China have got a bit of an issue with Jack Ma's attitude, and they seem to have pulled him into the boss's office, if you like, to sort of read him the Riot Act, and they're sort of showing him that, in my mind at least, who's in charge still. He has made some derogatory comments recently, and I think this is, it seems like a China issue, but it's not. There's a lot of investors that have been putting money into this IPO, and this sends a pretty poor signal for international investors going forward. And I think it's something that may need to be kept an eye on if we're going to see this continued capital allocation into China. This is rather worrying that they can step in and actually postpone this, and maybe even stop it altogether. Investors won't like that. Continue with China on the government side of things. China, Australia, I think these tensions are beginning to get worse. China has now said that adding to everything else, it's added lobster imports as well, giving some kind of excuse that they want them checked. We're looking at copper concentrates, we're looking at wheat, barley. You know, these are big parts of the Australian export monies that they make, and I think this is rather damaging. This all on the back of Australia trying to side with the US and look at investigations over COVID, and China have got very cross about this, and Australia are going to have to make a bit of a choice here, because this is quite a lot of money that we're talking about. You know, those commodities that they're selling to China are actually quite a large part of the export base of Australia. We saw the RBA, as expected, cut rates, but a lot of that seemed to have been priced pretty dovish, to be honest, in my view. But unfortunately, you know, those that were short got caught by a dollar sell-off into the election, US election, and basically the actual rate announcement and the statement had very little impact on the Aussie. Again, a lot of it was priced. The market was short Aussie, and we saw a bit of a squeeze. The Aussie, if you pull up a chart today, has seen a 100-point swing up and down and back up again. So, you know, this has been quite a volatile market, and you know, it's a bit of a risk trade as well. So the Aussie FX volatility starting to rise as well. You know, trades are going to be a little harder to hold on to. And then, of course, we still have the Brexit headlines. We actually had some pretty poor headlines. There was some suggestion of progress being made, but no breakthrough on the major sticking points. You know, phishing still becoming an issue. It's a political issue. I mean, this is 0.1% of UK trade, for goodness sake, and not much more for France either. You know, this seems to be smacking of politics, and I'm sure Monsieur Macron has got quite a lot to do with this. Loving being a thorn in the UK side, I'm sure. But they need to move on pretty quickly, because that clock is ticking very loudly now. Not long to go before we could get a problem. Oil's an interesting one. I think we've got to look out for oil. I think there is a danger that we start seeing another sell-off soon. Demand is just not there, and the lockdowns, I think, are going to increase that. And, you know, are they going to do further cuts? I doubt that. I think OPEC countries are struggling with revenue. I think they want to pump more oil. So I think we need to be very careful here. I think over the next month, you know, you'll hear me talking about oil a bit more. You know, I think the lockdowns do make a big difference. And you know, one of the questions here is the US delaying the inevitable and going to have to start locking down as well? I think that will hit oil pretty hard, to be honest. And I think there's already a you know, a structural move away from fossil fuels anyway, driven by governments and you know, many governments actually around the world now looking to change, like from diesel trains to electric trains, or even hydrogen trains, stuff like this. And I think that's ongoing. I think that is set now. And I think demand for oil is in trouble. And I think oil above $40 is going to be tough to stay there. So that could have an economic impact as well. Also, don't forget EU economic forecast being revised down rapidly. That's going to be a demand issue as well for things like that. So I do think we've got to be careful here with oil, and also the economic impact of these COVID. COVID is been moved to the side because the election is still there, still very real, and so is the US-China trade deal. So, you know, the US-China trade spat is the data has looked pretty good. PMIs, you know, looking forward has been pretty good, suggesting that China is the engine of global growth again, as it was. They forecast themselves to be climbing quite a lot from here. Non-manufacturing PMI climbed, which means the services sector, the consumer sector is quite strong, which is what they're trying to bring on. And, you know, to be honest, China is the only economy that's predicted to grow in 2020. So, you know, it's looking good. The only issue is there's a few caveats to this. Falling oil demand and weakening in global trade won't help China growth, because, you know, it's all very well the manufacturing stuff, but they've got to sell it to someone. And, you know, the developed world is not there yet. They are doing better with certain Asian economies, you know, selling to Korea and Indonesia and places like that. But the developed market is still rather sort of lacking demand. And I think the presidential election has certainly distracted the US, and you know, we need to get a result. But I think at the moment you know, it's worth realizing that China-US relations are still in the hot zone that we've mentioned before. Those who join us on a Sunday, we look at this hot zone. It's still in there, and I think realistically, relations with China are not necessarily going to change under Biden as well. I think people think it will, but for what I'm hearing from them, you know, these guys are talking something similar. I still don't think Biden's going to walk into the White House and take all the tariffs off. I just don't see that happening. They have issues with the dominance of China and the threat to China to the US standing on the global stage. So, you know, the issue here is that we've got to take a close look at those that feed feed China, and one of the biggest exporters to China is obviously Australia. We've mentioned this before, and if you look at this, you can see the dependence. Australia has almost mortgaged itself to China, and it's very dangerous for Australia to take sides with the US on a sensitive subject like COVID, because you can see what China can do, and this is going to be quite damaging. So I think Australia's got to be careful who they side with here. And again, it's part of this. We've spoken about this before, about this polarization between a protectionist Trump fighting China, and they're moving apart, almost like the Cold War with the Soviet Union years ago. And this is disturbing because it's very bad for global trade, but also the people in the middle are going to have to make some pretty tough choices, and Australia sits right in the middle of that. So it'd be interesting to see how this goes going forward, and whether China decides to sort of, okay, we've given Australia a slap and we'll bring them back into the fold, or whether they keep them out and they look elsewhere for their commodities. It's an interesting story brewing there. So forward, let's look forward at the markets. On the stock market side of things, again, you know, we updated this slide earlier today. They are going to continue to be dominated by the outcome or lack of it around the US election. The fear index got smashed today, you know, even lower than you can see on here today. All volatility got smashed as stocks rallied. So, you know, the market is in a risk on frame of mind at the moment. We saw tech stocks wobble last week. They are absolutely flying today. I mean, I think it was Apple was up 5%, was it? And Facebook 6%. The tech stocks drove everything today. Got the Fed this week. Unlikely to get anything new from them as far as I can see. Be interesting always to see what Powell says. And I think, again, he will be suggesting that whoever's in the White House in the next day, week, whenever it may be, needs to get on to sorting out the fiscal package that is so badly needed. Remember, you know, we are hoping for a vaccine. I'm not sure a vaccine is going to cure very high unemployment and possibly even long-term unemployment. We need to bear that in mind. I think companies are rapidly bringing on automation, and I think some of these jobs that aren't going to exist when they go back. And of course, a lot of people going back onto furlough now. US data has been pretty good. GDP data was backward looking. That's third quarter for the US and EU. You know, I think we've got to look at what's now. Markets are forward looking, remember, and Q4 is looking very risky, particularly in the EU and UK with lockdowns. The focus is going to shift back to the US employment, and it'd be interesting to see whether virus impact in the US actually starts hitting unemployment again in the US. On the currency market side of things, being cognizant of the time here, is that there is an uncertainty over the virus still, and it's unclear. I mean, we've had the dollar down today, but I think the actual structure of the dollar here is unclear until we get a result in the US election and we understand exactly what that means going forward. So very difficult to hold a position here. I think with volatility high in foreign exchange as well, I think being square is a reasonable position, or I think it's probably making us all short-term traders at the moment. And I think we need to sort of look at more smash and grab trades rather than taking a view and just sitting with it. I think that's going to be quite difficult at the moment. I don't see the Fed saying anything's going to impact the dollar a great deal tomorrow at the FOMC. Again, Powell could put something in there, but I think they're on hold. I think they want to see the election out of the way first, maybe even year end before they do anything. But I think tomorrow's one is going to be, let's keep it calm, let's get the politics sorted out, and then we'll start moving forward from there. So I'm not expecting much from the Fed, but obviously tune in, see what he has to say. I think the EU and UK lockdowns are negatives for the euro and sterling, but of course, you know, we don't know what the Brexit talks are going to do. They've not been going particularly well, as from what I hear from Barnier. He's saying they still got massive issues over fishing and the level playing field. So who knows with that? So trading sterling is going to be fraught with danger. And the Bank of England, we have a Bank of England meeting this week on Thursday. You know, are they going to talk about negative rates? Possibly talk about it. Will they actually act them? Don't forget, they're still doing a deep inquiry into the validity of negative interest rates, which is not due to finish till year end, beginning of next year. So for them to do it now, I think would be actually frowned upon. So I think they need to wait until they get the result of that investigation. But I do think they are looking at more QE. I don't think QE is going to help the economy, but it may actually take sterling down. I don't think it's going to do anything. I'm not even sure that negative interest rates are going to help the broad economy. This is about supporting markets and getting sterling down, I think. So again, it'd be interesting to see, but they've certainly got to sort of react to the fact that lockdowns are going to hit the economy. They're being advised by a lot of people that the Q4 growth outlook is looking pretty shoddy. So you could hear quite a dovish Bank of England. I don't think they'll reduce rates this week. If they do, I think it would be something of a shock because again, they're still looking into whether it's a valid policy or not. EU and Euro crosses were under pressure last week. Lagarde has been as bearish as ever, looking to do more in December. That's not gone away, but the Euro itself has been dominated against the dollar. Remember, you know, every currency has two legs to it. So Euro against the dollar has gone up. Euro sterling actually has actually gone down, or more or less stayed in a range, but on the lower end of it. Again, failed to sustain the break below. It broke very briefly. We thought it was going to go, and then obviously it bounced, and you know, that seems to be a bit of a false break now. So again, driven by a lower dollar and a bounce in stocks, and I think the market is looking at a risk on trade. I think people bought their Aussies back pretty strongly there. I think that was a bit of a squeeze. Had a wild swing today. But events that matter into the rest of the week, here we are. Usual suspects. US initial jobless claims tomorrow, 1:30 our time, GMT. EU retail sales in the morning could be worth interest. Obviously, the Bank of England. Have a look and see what they do at the rate meeting. I don't think they're going to do anything, but Bailey's press conference afterwards, you know, could be well worth. There might be a few issues in there. He may give us a heads up for the next meeting as well. That's a must watch, that one. Fed interest rate decision, clearly anything that happens with the Fed is massive. So don't forget to listen to the press conference. That's going to be key there. Be interesting if he does want to rattle any boats, but I doubt it. Non-farm payrolls, well, what can you say about that? It's a biggie, and it comes at a time where the markets are extremely nervous. So I think we're looking at a high volatility day on Friday. I think we may know a bit more about the election there, but whether that's taken stocks back down again or whether we've seen a massive rally, payrolls could change all that. And with these volatile markets, you're going to get swings here that are going to be really difficult to hold on to. So, you know, the big thing here is cut your exposure, trade accordingly. It's high risk, and look at your technicals. And on the technical side of things, I'm going to pass you over to the main man, my friend Richard Adcock. Richard?
Great, thanks very much, Mo. Good evening, everybody. You'll remember that last week we looked at momentum, which was the second part of what I think is important within technical analysis alongside sentiment and trending. And it's trending that I want to take a look at tonight. And in particular, the moving average convergence divergence indicator, which is the MACD or the MACD, as some of you may have heard it called previously. Basically, what I think really the trending indicators give us as an extra slant is that they give us the timing aspect they give us the directional aspect, while momentum gives us the timing perspective. So as a result, we don't want trending indicators to react that quickly to price action. So in other words, we need it to smooth out price action more than, say, a momentum-based indicator, which tends to give us the timing aspect. So the MACD is basically based on two moving averages, two exponential moving averages. And exponential averages give us the slightly faster reaction to price activity, in that they put more emphasis on the latest price data within the period. Now, if you look at an MACD on any charting system, the chances are that the default setting would be looking at the two moving averages based around something like 12 period and a 26 period. Now, there's nothing wrong with those periods and using those as a calculation, but in my sort of years that I've used the MACD, I've adjusted it slightly just to make it slightly more short term, and I tend to use a 10 and a 20-day moving average. And this basically gives me slightly earlier signals than the normal default setting. And basically, if I use moving averages, I tend to use the 10 and 20-day because I find them more useful in actually highlighting the turning points, the support and resistance levels as the trend develops. And if you remember back to the Bollinger Band is also based on a 20-period moving average as its central measure, and then the standard deviations are measured around that mid-average. So that uses a 20-period as well. So basically on this chart here, on the 4-hour chart of the Aussie dollar versus US dollar, you'll see that we have the blue line, which is the 10-period moving average, and the red line, which is the 20. And effectively what the MACD does is to oscillate around the zero level. So zero is neutral. If it's above zero, then it basically means that the shorter term average is higher than the longer term. And the MACD itself measures the gap between the two moving averages. So the shorter term average will follow price action more closely than the longer term. So effectively what will happen is that as prices rise, the gap between the two moving averages increases. As they fall, we'll see the averages converging, cross, and then start to widen to the downside. So the MACD measures this gap. So the blue line, which is the MACD indicator line, is the gap between the two moving averages. So we'll see that as prices start to rally and the gap increases between the two moving averages, the blue line will rise. Now the red line is just a 9-period moving average of the indicator. So effectively what we're looking at is just very simple crosses above and below the moving average to highlight the directional change within the market. I tend to use the MACD in a very simplistic way. I just simply want it to tell me where the directional trending conditions are within the market at any given time. So I will use the MACD just to reflect that trending condition. There are only 4 signals that I look for with the MACD, and it's the relationship of the indicator line, not only to its moving average, but towards the zero line as well. So zero is neutral, that's where both moving averages are at the same level. And a crossing from negative to positive, so crossing above the zero line, reflects that the market is trading within a bullish trend. So effectively, what I'm looking for, as I say, are 4 signals: an aggressive downtrend, a consolidation in a downtrend, an aggressive uptrend, and a consolidation with an uptrend. And the MACD gives us a very quick and easily reference to that trending condition. So for an aggressive downtrend signal, it's when the MACD is below zero and below its moving average. So we're effectively seeing the gap between the two moving averages increasing to the downside. Now, every time we see that setup, I've measured with the red arrows on the chart. So effectively, we're saying that these are considered to be aggressive downtrending signals. So that the risk is that the market will continue to fall for a prolonged period of time. Now, if that matches with widening Bollinger Bands, for instance, then it's a much more aggressive downtrending signal. And the chances are that that trend will continue for a prolonged period of time. So whenever you need to sort of gauge the trending condition of the market and using timing indicators from something like momentum, we can see that if we're looking to sell the market, we would prefer to be in this aggressive downtrend setup. So effectively, when the MACD is below zero and below its moving average, we're effectively saying that that's when we need to be more aggressive with our negative outlook for price activity. And the chances are that we will see a consistent fall developing. Now, a consolidation within a downtrend comes when the indicator starts to break above its own moving average. It's not a bullish trend, it's not a buy signal, because we're still trading in a downtrend. The MACD is still below zero. So the consolidation is a recovery, but still within the bearish themes and the risk of a more extended sell-off developing again. And as we sort of mentioned last week, when we look at slow stochastics and momentum, a downturn in momentum in a downtrend is the trigger for a resumption of these downside moves. So the consolidation is basically where we'll step aside from negative positions. We'll look for a more extended recovery, but still within the outlook that the market's trading in a bearish trend, with the risk for an acceleration or resumption of that downside move. And as I say, that will either come from the MACD breaking lower, but because it's moving average based, it would be much slower to react to price action than something like a momentum indicator. So we would use momentum as the timing signal, the much quicker, shorter term signal, and the MACD, the trending signal, to give us the longer term, slower directional risk. So we've got an aggressive downtrend, we've got a consolidation in a downtrend. And these are very important in gauging your timing within the market as itself. So the aggressive uptrend comes when the MACD breaks above zero and is above its moving average. So effectively, this is when the market is likely to see a much more prolonged move to the upside within a positive trending condition. So the MACD above zero and above its moving average is suggesting that we're in a more prolonged upside move. The positive trend is in place, and the risk is that that trend will continue. Now, again, if that coincides with Bollinger Bands widening, then again, that's the double whammy, if you like, of outright confirmation of a much more aggressive trending condition and the risk of that market accelerating within that trend. And effectively, that tells us that really you need to be active within the market from the long side within that type of setup. The consolidation within the uptrend comes when the MACD breaks below its moving average, and the chances are, because the moving averages are converging and the gap between those averages is beginning to decline, that we're in a consolidation area. So the risk is that we're looking for a pause within what is still a positive trend. Now, as long as we don't see any sentiment change from candlestick patterns, as we'll look at later in over coming weeks, or within price action, then the risk is that we will look for a resumption of that positive trend and more aggressive uptrends to develop. So by using the MACD, we can get a feel for the trending condition of the market. And effectively, when you're in an aggressive trend, either to the up or to the downside, that's when you have to be active within the market effectively, within the direction of that trend, because what the condition is saying is that we're looking for a much more aggressive and prolonged move that can carry much further than people are anticipating. And that effectively is where the greatest potential for price movement is in place. And we need to actually set our risks, set our trading strategies around that backdrop. So that's how I would use the MACD. Let's have a look at the current technical setups for markets right now, looking at the live examples. So Chris, if we can flip to the Pepperstone charts.
Just give me 1 sec, Rich. I'm just pulling out. Should be like 30 seconds at most.
Yep, fine, no problem. So just to expand on the MACD, you know, it's not a signal necessarily to be used on its own. It's confirmation of the trending backdrop, and effectively we're then looking for the sentiment aspect within price action to materialize within that structure. And it gives us extra confidence, if you like, in the trending condition of the market. And by using only one of those 4 signals, we can really sort of get a strong feel for how the market's trading at any particular time and how we can structure our positioning around that trend at that perspective. Okay, so let's now have a look at the live examples. Thanks, Chris. We'll start as usual with the S&P, and this is the weekly chart. And effectively, you know, the market has held reasonably well, considering that we closed last week below the mid-average of Bollinger Bands, which obviously we've held above and previously, and we've reflected that as quite an important support focus. The one point that I have highlighted as the important support point was this last correction low. So effectively saying that, you know, to develop the negative themes within markets once more, we'd be looking for a break below that last correction low and effectively start to put in lower highs and lower lows, or the basic definition of a downtrend. Effectively, what we really have at the moment for the S&P is the fact that we've held above that low and rallied obviously pretty well, and Mo's gone into the reasoning behind the upside move and the stocks that are dominating that overall structure. The fact that we've rallied well from above this low, and we're now looking at the daily chart, you can see that we've broken back above the mid-average. Now, the theme this week, I think, with all of the charts that we look at, apart from perhaps the gold and oil at the end, is that the current activity is basically forming some very broad, choppy, sideways trading areas. And effectively, this is an indication of the current backdrop within the market. I was listening to a news report earlier regarding the US election, and the reporter was basically saying that there's a lot of questions that still need to be answered, and that effectively sums up financial markets at this stage, because we've got equity markets sort of having tested lower levels, rallying strongly, but they're still within a sideways trading range. Yes, we're seeing more positive themes by the fact that we're breaking above this mid-average, but again, with the overall Bollinger Band structure and price action, this is still a more choppy sideways trading range, and effectively that suggests that we can continue this type of activity over coming sessions. And yes, within this upside, we could see retests of these previous highs, but it's still very much from a longer term perspective that we would have to either break this high or break this low to suggest that we're looking at a more significant trending condition of developing. You know, last week we had the risk of bears gaining the upper hand. That would have been suggested and confirmed by a break below this last correction low. They've managed to hold above that point and rally strongly. So again, it's still very much a similar sort of price action looking at this previous high, and we would need to see the breakout from this choppy range to really establish the next directional risks. Very similar picture for the NASDAQ. You know, we've broken above the mid-average, which is effectively flat. We've held above the last correction lows. So effectively, this is still a very choppy sideways trading range, and it's a decision-making process. The trading range is basically an indication of balance from a longer-term perspective. As the market battles for a directional bias, and effectively the rally and hold above these lows suggests that we are still trading in a more choppy sideways trading range, and that effectively is quite difficult to trade because the volatility is quite high with this latest move, and we would need to see a breakout developing from price action. Now, as you'll see, this is the euro dollar, and you'll see with the other dollar charts that we've got and we're highlighting today, it's very similar sort of price action in that we're still trading in these choppy sideways trading ranges. Bollinger Bands, the mid average is flat, the bands themselves are flat and parallel. That's a sideways trading range. Upside today has been held by the mid average and also the retracement point of this downside move. Effectively, we tried to break lower today. We rejected that pretty quickly. And this obviously confirms the support at and just above the 116 level as the important support point to monitor. So really for me, euro dollar and the dollar strength in general wouldn't really be signaled until we start to see these support points giving way. For the upside, again, it's still sort of closer towards the 119 level as the resistance area, the upper limits of these Bollinger Bands. And while we're in this type of setup, it's still a more balanced theme and the market is still trading in a sideways range. Aussie US, very, very similar. Obviously, both Mo and myself have been talking about this 70 level as being a very important support focus for Aussie US. And this last correction low was tested in a much more aggressive way over the last couple of days, but it's held and the market's rallied back. But again, this is not an aggressive setup within the general structure for Bollinger Bands. We're still seeing a flat, sideways moving mid-average, parallel bands. Still some pretty strong overhead resistance, not too far above current levels, in the same way that the 70 is a support point. So effectively, we would still need to see a breakout from this range to really sort of develop the next phase. Now, if it is a risk-on move, then that would suggest dollar weakness and the chances of this breaking to the upside and overcoming this high and then starting to see more volatility and positive things beginning to emerge. That isn't in place yet, and this is still very much a watching brief. It's a bit frustrating, but there's really no sort of longer term trading structure within place. And again, the daily charter cable, it's still very much the balanced theme. The MACD is above zero, but it's below its moving average. So it's a consolidation within an uptrend. We would need to see this starting to cross higher, staying above the zero line. But again, it's still very much the recent lows, recent highs being the focus, and we would need to see the confirmed breakout developing from that range to establish the next themes. For gold, on a daily basis, also sideways. There are a lot of questions that the market has to answer here, not only in FX, but also in commodities, and to a certain extent to equity markets as well. We may be looking at slightly broader sideways ranges in equities, but we are still caught within sideways activity. And we need to see a breakout developing from these ranges to really establish the next directional risks. And from a trading perspective, yes, it's in a range, and the support is at lower limits and resistance is at higher limits, and that is a trading opportunity. But to get a much more sustained and prolonged trade and trend developing, we need to see breakouts from these ranges emerging. So then looking just finally at oil, as Mo was saying earlier, we've seen the market rallying back above the 40 area. There's a lot of congestion, a lot of resistance above this point, and we're only sort of now approaching the mid-average as well. So above 40, it's potentially going to be quite a struggle around this area, and we certainly need to see much more significant activity to break above this mid-average and these previous highs, sort of stretching up to the $44 area, and that still seems to be quite a significant feat from here. So I wouldn't necessarily be trusting upside in oil, and the risk would seem to be for sort of more choppy trading activity to materialize from around current levels. So we can hope and Chris, if you want to flip back to the main presentation, please. We can hope that later in the week we will have clearer pictures, be it from the election results, or it may well be something happening within non-farm payrolls towards the end of the week, where we can hope that we can see breakouts from these trading ranges. But really at this stage, it's just a matter of watching the ranges form and seeing and waiting the breakouts before we establish the next directional risks. So that's the technical picture. I wish it could be sort of more interesting, but something I'm sure that is going to be very interesting is Roger sort of going into our next trading strategy, which is adding to a winning position. So thanks very much, Roger.
Thanks very much, Richard, and good to be back. Good evening, everybody. Tonight, a couple of sessions. Although this one's labelled as a trading strategy, for me, I see it as much a discipline and a mindset in our trading, and I'll go into that as we move into the charts. But again, what I'd like people to be looking at here is seeing opportunities. You know, for me, it's the visualization of those opportunities. And once the more you see the opportunity, yeah, the more you can grasp it. So, Chris, if we move on to the chart, we're just going to reiterate a couple of things here. We are going back to April, May. And looking at sterling versus the dollar, and what we see here, and if we think back 2 weeks when I was talking about trading those ranges and breakouts of those ranges and looking at playing that supply and demand vacuum, we've got a similar situation here where we've got those ranges, and some people, as I said before, I think, why do I want to play ranges? They're boring. Sometimes these ranges are taking a week to progress. But for me, there's 400 points in that range, and if I can get one side of that, I'm going to be very, very happy, because I feel I can take that trade with as little stress and strain as possible, because I feel I know what's going on, and I'm nicely protected with my stop losses. So we're going into this, and maybe we have had the chance to play a bit of that range, but when I first spoke about this, one of the key things I said, if you're starting off in trying to trade these ranges, the support and resistance, is to start with the trade that you feel most comfortable with. And if underlyingly you felt sterling was going to be a bit weak, you felt Brexit was going to keep rumbling on all year, then maybe you'd be playing that short game, and that will be your first entry point. So each time we got up to that resistance level, we sold, and we maybe sold our 100% because we're going to put a type stop loss so we can have maximum conviction on the trade. And as it comes down on this particular run from the resistance level, we started to get Brexit issues coming up and flaring up again, and clearly we've got this short sterling dollar position on, and we actually start liking what we're hearing. Now, as we play that on, clearly, as we get down towards the support level, we do have choices. We are short, we do like it, but you know, is this just going to keep rolling on? Is it just a reiteration of previous Brexit issues? You know, so we may actually decide to continue to play against that support line and buy 100% back. But we also may decide that we quite like sterling to go a little bit lower. So we do have that option of buying some of our position back. And whilst we got 50% on the slide there, clearly that is an option that each individual will take, and if they choose to make that 60, 30, whatever that percent is, that's your own decision as a trader. And then the other side of it is obviously to stay with the short position and not buy any back at all. And then obviously you're very, very focused on that support line. You feel it's going to break this time, but also in your mind have that backup plan that if we start moving back up towards the middle of the range, Have you missed an opportunity? Has the news disappeared? And again, that's part of our reassessment of what we do and the decision we made. It doesn't mean to say that your decision was wrong in buying back, or your decision was right in buying back. It means you made a decision and the market played out in your favor. Similarly, if it does start bouncing back up to the middle, and you decided you thought it was going to break that level, you haven't made a bad decision. You decided to stay short because you think all the evidence was there for it to break that line. But these things will happen, so have a plan in your mind if it starts to go a little bit away from what you thought. So now clearly, as we roll the tape on, we break. And what do we do whenever any important event happens here? And the important event here is that we've broken a key support line. We have to reassess the position that we've got. We're watching the market, we're watching the price action, and we will have already planned our trade if we break that level. And what are our options if we break that level? Well, clearly, if we've already bought the 100% back, then we're flat. We may decide that's good enough for me. I've had a good run. I enjoyed playing that range and I'm absolutely fine with that. If we're 100% short, i.e. we didn't buy any back, we reassess the technicals when we break through. We look at potential buyback levels, i.e. do we want to put a stop loss if we break back above that support line, if it's a false break. And remember what we spoke about, smart execution in terms of not putting it right on that support line. If we bounce back over it, give the market a little bit of space to confirm that the break is false, and then you take your, well, it becomes a take profit level in actual fact, because you're short way up, and there's nothing wrong with taking profit. But one of the key other things, and again, this is where for me it's the mindset. If you decided to take 50% of your position back, hoping, that's quite prudent, it's a very good trading choice, hoping and thinking that you're going to make good money out of your 50% when it breaks through that support level, one of the key things about making your good trade ideas into great trade ideas is to maintain that discipline that when things are going right for you, you have maximum leverage. And for me, if you've made that decision to take a percentage of your position back above that support line, but you still believe sterling is going down, when that proof is there, when we break through that level and you've got some confirmation that it's not a false break, that's where we need to be aggressive again. That's where we need to add to that winning position. We're already winning, so we've got a positive tone to our trading, and that's key for me now. Add to that position, increase your leverage, go back up to your maximum conviction. Remember, you've got that key support line that is giving you good information and can make any stop loss cheap on this extra 50% that you've sold out. And then two things happen. It either bounces back up through, negates your trade, you stop yourself out quickly on that 50% in this instance that you've sold out, or you watch the market go in your favor. And there it goes. The great thing there, you've sold right up on the resistance line way before. You bought 50% back. You sold 50% when you got the confirmation of the breakthrough, that key support. And now you're sharing in that downside move with 100% conviction. Don't get hung up on the fact that in this instance, if you'd have bought, let's say you bought your 50% back at 122.60 or 65, and you didn't manage to sell that 50% back out to 122.40, don't worry about that 20 or 25% ticks. You haven't lost that money. What you've done is taken a prudent stance, but when things have gone back in your favor, you've been aggressive to get yourself back on that trade. So ignore that 20, 25 points. You haven't lost it. It's just part of the process and part of your planning of that trade to make sure that you're leveraged maximum when the market starts moving in your way. So hopefully that helps. I think it's a very, very important thing. Sometimes people really forget and get lazy around that. And yes, great. If you've got your 50% and it's gone down, you're still making money, but you've missed an opportunity there. So I think now I've just got a quick slot here, and I think it's quite important that we do touch on the psychological side of trading from time to time. And the first couple of slides really are just a reiteration of some slides we put up, I think, on the second session. And, you know, maybe we got some readers on that didn't see these slides, and I'll do a very, very quick reiteration. Emotions will drive your trading. Fear and greed are the key ones. We've got them in the bad slot on the right-hand side, but there's also some kind of good emotions that you may feel, you know, if I've got these, I'm a nice person. You know, I'm pretty controlled in what I do, but I see some of those good emotions can be disruptive and destructive to your trading as well. So for me, the key from this slide is we're human beings. We all have some of these traits sat within ourselves. Just be careful when they start to move out to the extremes. If you start getting too aggressive, if you start getting too frustrated, you start making bad decisions. If your confidence turns to arrogance, you get lazy in what you do. You think nothing's going to go wrong. You know, if you're passionate about it, you know, that's a very, very good thing. We should love what we do, but sometimes you get too passionate about it, you get married to trading positions, it can be bad. So the key message here is to try and stop things moving out to the extremes. So how do we help you do that? Well, the key thing for us is letting the method dictate your emotions. So hopefully you're picking up over the weeks. We're trying to instill a method and some structure and some planning to what you do that can help back up all the great information you're getting from Mo, all the analysis and the technical analysis that you get from Richard. They all fall into the melting pot, and hopefully you feel there's some structure coming there that helps you promote your ideas and make money out of them in the marketplace. So just those, you know, the quick mantra on the left-hand side, breathe. You know, we have to stay in control. We have to stay calm. Reassess at all times. You know, make sure you're doing your reading and your research. Things can change that can stop your idea making you money. Reappraise your risk. Have I got enough in it, as we've just discussed? Have I got too much in it? As Mo mentioned, we got some very, very tricky times at the moment. So, you know, sometimes we may feel we got too much risk in it. We should be reappraising this all the time and keep that discipline. And then obviously when we get to execution, the little things that we're putting in there in terms of smart execution, planning your trade and then going to market with it. Understanding your own limitations. We all got our own personal limitations. We're not clones of everybody else. You know, some people can handle lots of big risks, some people can't. But it doesn't mean to say those that can't handle lots of risk can't be successful traders. You just trade to your optimal level of risk in the marketplace and you'll still do well. And so that's how we think, you know, we can control those emotions. So let's see how things can change, you know, from when we're trading short term to when we're trading long term. And, you know, Mo made a very, very good point. You know, these current markets, maybe the best thing to do is a bit of smash and grab. The first thing we need to understand from smash and grab is that you actually probably need even more discipline. So short-term trading, smash and grab trading really does heighten the stress levels. You're probably doing it because the markets are fast, you want to be in and out, maybe because your risks are higher, maybe because you see your profits quicker and your losses can build much, much quicker as well. So you're always on edge. So again, we need to stay in control emotionally and be aware of those extremes. The discipline has to be very, very rigid. You still need to go into your smash and grab short-term trades with some targets. Don't just press a button blindly and think, I need to buy this. You still must have an awareness of your marketplaces. Some of the technicals, you should have read those before you go into your sessions trading. So you know where the critical areas are, and certainly the areas where you don't want your position to go. One of the hardest things here is that you're generally going to be managing your risk on the fly. And what I mean by that is you'll be pressing a button, you'll be going long of an asset, and because it's a quick trade, you may not have time to put your stop loss in. You've still got to have that stop loss in your mind. And the big thing here, don't get married to a position because you're frightened to take yourself out of a loss. That's one of the biggest mistakes that people make. When you're on the fly and you say to yourself, if this goes through 40, I've got to sell out, but I haven't had time to put an order in the system because I'm doing this very high frequency short-term trading, you've still got to be very, very disciplined and get out when it goes through 40. Because what happens is if you don't, it gets to 30, it gets to 20, and then you're frightened to press that button to take your loss, to crystallize your loss. One, because it's too much. Two, because you start relying on hope that it's going to bounce back. That's why the stress levels are heightened. So you need to maintain very, very strong discipline. One key thing for me here is avoid over trading. Impulse or momentum trading can be addictive. It requires close to zero research or planning. You're doing it a lot on gut instinct, and we do believe in gut instinct. But the problem is, if you trade too often, it gets into that law of large numbers. And by that, we're basically talking about the toss of a coin. And we do not deal as professionals on the toss of a coin. So please avoid over trading. One of the reasons you need to avoid over trading is because when you're doing your short-term trading, you can't really assess each of those individual trades at the time. You can only do it when you're square. You can only do it at the end of each trading session. So if you're just continually trading, you're never giving yourself that opportunity to sit back and understand what you've really done. And over a period of time, it probably won't become a zero-sum game. It will probably turn to the negative because you'll get tired, you'll start making mistakes, you'll fall into the traps of taking your profit too early and running your losses too long. So again, if you're going into these trading sessions, this short-term trading, try to have a situation where you get yourself square, you can sit back, take stock of what's happening, and then you can go back into the marketplace. But it just needs to be a bit of a discipline here in terms of how long you're in the trading arena before you can actually assess what you're doing. The point down the bottom again goes back to that level of personal risk and your own limits. And it's very key that you understand the successful traders are the ones that understand their own limits. You know that level of risk. So when you start trading on a repetitive basis, it's a smash and grab trade, you've probably got an amount of risk you're prepared to put in that marketplace. You need to be able to cope with those numbers. If you start too big and the loss numbers start getting too big, it's going to affect your well-being. So don't overstretch yourself. If anything, early on, start going in a little bit smaller, try and build a bit of success, get used to those numbers, both from a profit perspective and importantly, a loss perspective, and build your trading up from there. So hopefully some help there if you do get into the short-term trading. And now just looking at the longer-term trading, and we do bang that drum that we like people to put a bit more structure into their trade. It still does bring its issues, but as we say here, we try to let the process, the method dictate our emotions, really help our psychology so that everything we do is very, very structured. If we read the research, the fundamentals and the technicals. It brings us our idea generation. We do some initial planning, we get a strategy, and through doing that, we're automatically introducing some calm, control and purpose into what we do. From then on, good understanding of our risk management and our order management tools, the trailing stop losses that Richard spoke about, I think, last week, and plenty of the other little tips and maybe trading strategies that we're bringing in over the weeks. These are going to create opportunity for you. Not every trade will be the same, so you don't get into this boring rut every day. Every trade idea should bring a different trading strategy. And that's good for your heart and soul as well, because you're ever interested in the marketplace and some of the optionality you have to put a trade on and take money out of the market. Use that risk barometer, because again, this is going to maintain your positive psychology. Make sure that on your good trades, you're optimally leveraged, and on your bad trades, once they start going bad, you recognize those quickly, you get out of them quickly, or you're in that situation where you haven't got so much risk on because you didn't have the conviction that you may have had on some of your better trades where you go in with higher leverage. Stay patient. That's one thing I will say from these longer term trading. It's very important you stay patient. Sometimes if you don't, you take your profit too early, then the market moves in your favor, you miss out on a great trade. The longer you stay in a trade, and you'll hear Richard say, why would I get out of a trade? I'd only get out of a trade when the market's telling me I'm wrong and I should be getting out of it, whether that be a technical analysis assessment that's basically telling me this market's going against me, or there's a piece of news come out, or some scheduled data that doesn't quite go in your favor. The more you stay in a trade, the more information that comes to you, and thereby more opportunity to leverage that trade to its maximum extent. You have to stay disciplined. You will still get emotional, but as we said, if you got this structure right, you should be able to stay in control of those emotions. Every time there's a price change, every time there's some news that unfolds, you're doing that reassessment. And again, this is a good part of what we do. So learn to trade all those, learn to basically look at that information, interpret that information as best you can, and then move the trade on from there. And sometimes that means you will take a loss, you will cut that position. Sometimes it means you'll carry on that position, and sometimes you may add to your risk. But it's important you reassess and you interpret that news as well as you can. And then the most important thing, and this comes for both whether you're doing short or longer term trading, you have to learn to accept that you'll get trades wrong. Assess those trades, get that diary out, read as to why you thought you were going into that trade, what were the reasons, why you put a certain amount of risk into that trade, and then work out what went wrong, what went right. Sometimes you make profit, but you could have made more. So you do your diary, you do your reassessment, but don't make it an autopsy. Don't make it a post-mortem on what you've done. It's a quick reflection on what you've done so you don't make the same mistakes again. And the key thing is, if you have lost money on a trade, don't dwell on that negative. Park it, move on. It's just another trade. The market is there to provide you with more opportunity. Go find it. Go find that next winning trade. So hopefully that helps. And I'll hand you over to Chris for some questions.
Thanks, Roger. Thank you to all the mentors. Sorry we ran over a little bit tonight. The main reason was that we wanted to get that election, the US election stuff in there at the start. So bear with us on that. We do have some questions. Morris, one for you. Longer term on the dollar position, you know, where do you see, like, on the dollar index? Do you see that there's a chance for it to bounce up to that 95, 96 area before it sells off again, or is it, what's the sort of range that you see?
Well, I think as Richard pointed out, Chris, is that you know, we're sort of mid-range on many of these, and I think that the direction is actually quite unclear at the moment. I think one of the things that's going to be driving the dollar over the next few days and possibly even weeks is the risk on, risk off attitude towards the election. And I think within that, we've also got potentially a Brexit decision coming up, yes or no, whether we stay in with the deal or not. And I think these things are going to actually impact the dollar quite a bit. So having a clear view of the dollar popping up to 95 on the DXY, I don't think it's as simple as that at all. Yes, it's possible, but I think for that to happen, you'd have to see you'd have to see stocks down quite a bit. I think stocks are definitely the driving force at the moment on risk, and I think that is impacting the dollar. I think realistically we are, you know, in a time of flux. I think that the technicals showed that very well today, and I think realistically, looking at the fundamentals as well, I don't have a clear view of where the dollar's going to be in the next week or into year end. I think we have to play what's in front of us, and I think for me to sort of say yes, I think the dollar's going up, and to put that trade on and stick with it is going to be fraught with risk. I'm sorry to be vague, but that's where I think we are right now.
That's fair enough. Just a question on the US election. The market seems to be, you know, desperate to get on this Biden win trade in some form. But you talked about the court challenge there. Do you think the market's pricing that at all, or is it ignoring it because it's, you know, maybe it waits to see what a couple of days? I saw there's some headlines out about they're already the Republicans are already getting a legal challenge ready for the Pennsylvania side of things. So do you have any thoughts on that?
Yeah, I mean, Chris, the issue here is that it's a potential threat, and you know, I think, you know, as I said, there's no way Trump's going to walk away from this elegantly and admit defeat. So I think there's a sting in the tail here. Whether they have enough evidence to take this to a Supreme Court or just potentially, I think first of all they're going to need to see enough evidence to need a recount in certain areas to start with. But they're going to have to come up with some solid stuff to suggest that the Supreme Court should look at this. This is not something you can just say, oh, well, I want a Supreme Court decision on this. There has to be a process, and the process is that you have to prove negligence or fraud or whatever, and I think that's going to be pretty tough. I mean, the voting system in the US is relatively sound. It's not quite a banana republic yet, but I think realistically the dangers here are that the market, when he first announced that in his broadcast this morning, stocks went down quite a bit, but they bounced right back up and way through those highs that we saw at the time. And I think what they focused on is the potential result, and the result seems to be at present a potential Biden win with the Senate unknown, and so there's some risk there. But certainly tech stocks have taken this as, no matter what comes out, it's good for them. I'm not sure that can hold, and I think that there's a certain amount of risk and hope in that. But I think you know, certainly if this does go to Supreme Court, stocks are going to suffer because that will bring in a certain extra uncertainty. Whether he can get it there or not remains to be seen. But again, the stock rally is pretty impressive considering there is some risk out there still, Chris.
Okay, that makes sense. Thank you very much. Somebody was asking about your thoughts on Kiwi, and I know that you were saying about there's a lot of ranges out there, but I'll pull up the chart for you, if that's all right, Richard, if you can go through it.
Yeah, great. No problem at all. Yeah, I'm afraid it is sort of very similar to the other US crosses in that it is still caught within a sideways trading range and not too much to really change within that. So let's just have a look at the
There you go. I've just given you the control of the mouse.
Yeah, brilliant. Thanks. So let's have a look at the daily chart on this, just to sort of give it a slightly longer term perspective. And as you can see, it's still a very much a sideways choppy trading condition. There is a slightly sort of upward sloping channel, if you like, sort of connecting these lows, connecting the recent highs. But again, you know, as I normally do, I'll sort of go on to the Bollinger Band and just sort of get a feel for how the market is actually trading in terms of volatility and how the trend is establishing itself. And we can see that, you know, it is a slightly more constructive backdrop for the Kiwi, in that we have got an upward sloping mid-average, but it's not exactly an aggressive backdrop as we stand at the moment, and it's still the resistance sort of up to the 68 and just above that's going to be an important focus. I mean, the general backdrop is that perhaps we can test that area, but as with all of the other structures that we've looked at this evening, we're effectively looking at sort of having to break above that type of level to really suggest that we're looking for a much more sort of prolonged move. And if we look at the weekly chart, we can see even more that it is a sideways trading range. We're still holding on that mid-average, which is constructive. There are still more positive themes, but we would need to establish ourselves above that 68 level to really sort of be the next trigger for a more prolonged upside move. So it's more a watching brief at the moment, slightly constructive, with an upside bias, but further work to do, I think, which pretty much sums up dollar crosses in general at the moment.
All right, well, thank you, attendees. Thank you for everybody that signed in tonight. I know it's a busy time right now. Thank you to the mentors. Have a great trading week ahead. All the best. See you next week.